quickly to just give a bit of revision on where we're coming from. Remember, our focus has always been on financial risk. And I told you there are three types of that. You have the liquidity, you have the market risk, and we have the credit risk. This is our focus. And this one is also divided into price, FX risk, and interest rate risk. Yeah, we're not looking at price risk. We've dealt with FX risk. We said FX risk is divided into three as well. You have the transaction risk, which is on either you're buying or selling in foreign currency, or you are borrowing or lending in foreign currency. That's transaction risk. We have the translation risk, which is on revaluation of balances by financial reporting accountants, what they do every month. So this is translation. And the third one is economic risk. Economic risk, you are exposed to economic risk when you have investment in foreign subsidiary, right? And I told you that we're not looking at these two, though you need to know them in terms of their definition. However, all you have to do is to focus on transaction risks for those method of reducing risk which we looked into. So for transaction risk, we say there are two ways we can use to manage them. Either we use internal method or we use external method. Internal method, there are several ways. You can issue in local currency, you can do matching, or you can do lead payment, which is immediate payment or immediate settlement, right? And for external method, I told you can use bank or you use derivatives. Yeah, for bank, you either use forward or money markets. And we've dealt with this, we've dealt with all of this. This is what we have left and this one. So what we want to focus on today in this recording now is to finish up on derivatives and interest rate hedging. How do we manage interest rate risk? Right. So that will be our focus. And for both of them, it's nice and interesting because you don't have to do any calculation for this paper. Any calculation will be in your AFM. Right. So let's look at derivatives quickly. For the guys who have been doing financial reporting, you probably have heard of derivatives before, but if it's your first time, you probably have heard about also is complicated, it's difficult. For this paper, we're not going into the details. I'm just going to give you the introduction. The awareness is all you need. Yeah. So what is derivatives? Derivatives are financial contracts. So there are always contracts involved between two or three people, right? And those financial contracts don't have values on their own. So they usually derive their value. So financial contract that derive value from the underlying asset. So usually there is always an asset involved and the value of that derivative is subject to how the asset is behaving. So which means the asset has its own value and the value of the asset is not the derivative. However, there is a contract tied to that asset and that contract has to be valued. And that contract is what is referred to as derivatives. Usually there are four major groups. There are so many types of derivatives, but there are four major groups. Other ones find a way to derive their names from these four. You have forward, you have future, you have options, and you have swap. Right. Forward is what we have already looked at in the service of the bank, right? And the remaining three we'll look at now. This swap is what we're going to use to manage interest rates risk, which I will explain when we get there. So for FX risk, these are the two that we're going to look at right now. Yeah, because we need to have an awareness. So let's take future for an example. Yeah, first thing, what I'll tell you about future is very similar. It's almost the same thing as forward. So this is very similar to forward transaction, yeah, which we have really looked into. Remember, what did I tell you about forward? I said it's contract, yeah, between two people. So you also have contract. Remember, they are derivatives, so they are always financial contracts, right? So contract between two people to buy or sell specific amount of currency. So specific amount of currency at specific price, which is your exchange rates, and at a specific future date. So the same definition is applicable to future. So this is future as well. Now, why is it now different from forward? That is what I will use to complete this definition. So is when you now compare the future with forward, future is different because it is regulated. Remember, forward is over the counter, it's an OTC instrument. You can sit down with any party and determine the amount you want to buy. Yeah. However, when you are talking about future, you cannot determine your amount. You have to pick from the standard amount that is available. So not any amount. It's not that flexible. Market will have maybe in 10,000 volume or in 1,000 volumes or in 5,000 volumes. So you must choose from standard amounts available in the market, right? And it's also interesting because though we said in a future specific date, that is when the contract expires. However, you can sell or buy an existing contract before its expiry date. So there are people that even trade in futures. They buy and they sell. So therefore, you can conclude that this is much more flexible in terms of exiting and entry. Yeah. Much more than forward. Entry and exit. But forward is more flexible when you're talking about amount because it's OTC. Right. So that is all you need to know about future. Very similar to forward. It's not different. Yeah. You won't be asked to do any calculation on future. You just need to understand. If there are major things you need to know, these are the major things you need to know because this one is already similar to forward. Yeah. So if you know this from forward, then you need to add this to it and you are home and dry on future. Now let's look at options. Remember, we're looking at derivatives, options. What are options? Options are just right to buy or sell currency amount, yeah, at specific rate and also at future dates. So it's like a forward, but the only difference is that it is a right. It is not an obligation. Remember, forward and future are obligations. These ones are obligations, just like you have in forward. But options is just like future and forward. However, it is not an obligation, it is a right. So you can decide not to exercise. So you can decide to ignore. Because if the market doesn't move in your favor, you can say, no, I'm not doing this again. I'll just leave it. That is the difference. Yeah, and it can be like a feature of forward, which means it can be regulated on or over the counter. So this can be regulated just like future, or it can be over the counter like forward. Yeah, and I'm sure you know that you cannot just, because you are able to walk away easily if the market doesn't go in your favor. That gives you a bit of flexibility. That flexibility is not free. So usually you get a premium, you get an option at a premium. So you pay something, just like insurance. So at a premium when you buy. Because whoever is selling that option to you will not be carrying your risk for free, because when you buy an option, the easiest way to explain it to you is that it's like you are buying an insurance. It's like buying an insurance. That's the way to explain it, the easiest way. Yeah? So, what does this tell you? It means that whoever is selling option, yeah, buyer pays the premium, yeah, seller gets the premium, and which means the seller will have an obligation because they have paid him for that service. It's like insurance, like I said. The seller is like the insurance company, and the buyer is like the policy holder, right? So whoever is buying it has the right. So if the person decides to exercise that right, this guy must comply because that's an obligation. So I need you to understand that, because generally people just say option is right, option is right. It's only right to the person buying it. It is an obligation to the person selling it, but it's subject to the buyer saying he wants to exercise before this obligation crystallizes. Okay? So option helps you to protect your loss without you losing the upside benefits. Remember, if the market is looking so good that you don't need that kind of insurance, you can ignore it and go for the upside that the market is offering you. Right? So, and that is why you are going to get it at a premium. It's not going to be free. Yeah? And I can give you, to break it down, what I'm saying here is, imagine that if rate moves against you, you can say, I'm not doing, you trash it. You trash the contract and you ignore it. All you will lose is just the premium you've paid. So take, for instance, if you say you want to sell pounds, so you say GBP at $1.36 per GBP. Let's say this is the option. You have an option to sell. So let's write it for. So you have option to sell GBP at 1.36 on 31st of December 2024. If 2024 31st of December comes now, and let's say the actual rate now becomes $1.3 GBP. So which means your contract says I will sell 1 GBP to you at 1.36. If actual rate in December now becomes 1 GBP is 1.3, you will be excited because you will not sell at this rate. So this contract is fantastic. And that's where you say, if the actual rate is this, then your contract is said to be in money because it's profit from the actual. Because lucky you have already set a rate of 1.36 for that date. And that means you will get 0.06 profit on each contract unit. However, let's say the actual rate is $1.4 per GBP. So this contract will be said to be out of money because of what actual is saying. Because the actual is saying 1.4. So the contract that we were thinking will help us, that 1st of December, is no more useful because it is in loss. And that loss is about 0.04. So because of that, because it's a right, it is not an obligation, we can walk away and ignore. All we will lose is just the premium we paid when we bought this contract. So that's how options work. And it's as simple as that.